Hi guys, welcome back. I am Vivek Singhal from tradingwithvivek.com, and today we are going to talk about the debt equity ratio. That is one of the most important financial ratios while analyzing stocks on fundamental background. And here we will understand the theoretical part as well as how can we use it practically while analyzing stocks. So before moving ahead, there is a small disclaimer that whatever stocks we would be discussing here, that will not be a recommendation to buy or sell. That will be only for the purpose of illustration. And if you have yet not subscribed the channel, do subscribe because I will keep on coming in with new videos to improve our trading and technical skills. So let's first understand the theoretical part, and here is the formula. The formula is very simple, that we need to divide debt by the equity, and we will have the debt equity ratio. So if the debt is 500 crore and equity is 250 crore, then debt equity ratio is 2. So here in debt will include long-term debt as well as short-term debt, and equity will include share capital and reserves. These are the bifurcation of all both the terms. Debt is inclusive of short-term and long-term debt, and capital equity includes share capital as well as the reserves. So this is the theoretical part is very simple. This is the most simple calculation in financial ratios. But here let's understand the next part, which is much more important, and that is how to use it practically while analyzing, and how to filter out great companies based on this. But this debt equity ratio can never be used on a standalone basis, that this is the only means it cannot be used like that. This is the only financial ratio based on which we can select companies and we can invest. This is one of the important financial ratio, but it cannot be used on a standalone basis. So here we have again selected 10 companies as on 31st July 2017. Those are having minimum debt equity ratio, and we have on the another side selected 10 companies. Those are having maximum debt equity ratio. Those are having maximum debt in comparison of equity. And let's have a look at what is the price performance of these 10 companies. So here is the list of those 10 companies. Those are having minimum debt equity ratio, and this is number one, Infosys, then Bosch, ACC, ITC, Ambuja Cement, TCS, Bajaj Auto, Maruti, HCL Tech, and Infratel. So if we have a look, so here three companies, Infosys, Bosch, ACC, there is a zero debt. So these companies are called zero debt companies as well. And from the health of balance sheet point of view, nothing can be better than this as far as the strength of the balance sheet is concerned, that there is no outside borrowing in the company's balance sheet. That is the great scenario as far as the overall health is concerned. But sometimes for the sake of going on a rapid path on growth, then we may require to have some debts just to push up the sales and to expand the business. So if something like that happens, then there is nothing wrong, but that should not be beyond the capacity to repay the debt back, and it should not have a burden on the net profit margins and all. But if we do keep aside all these parameters, and if we do simply have a look at that, these 10 companies, those are having least debt equity ratio. What has been the performance of all these stocks over a period of last 3 years, from 31st July 2017 to 31st July 2020. So here is the performance, and Infosys has given 91% gain, Bosch has given 46%, Bosch has given minus 46%, ACC minus 18%, ITC minus 32%, Ambuja Cement minus 16%, TCS 83%, Bajaj Auto 7%, Maruti minus 19%, HCL Technologies 58%, and Bharti Infratel minus 52%, and the average of this portfolio is 6%. So if we had invested 1 lakh in each share, that is the total trading capital is 10 lakh, then our portfolio would have grown to by 6% over a period of last 3 years. This is not a great performance. We do know that this debt equity ratio cannot be a single standalone criteria to reconstruct or construct the portfolio, but if we do consider this, then we can avoid a big loss, because we can filter out those worst companies in the Nifty 50 stocks. So these 10 companies we had chosen from the Nifty 50 stocks, those were having least debt equity ratio. Let's have a look at the 10 companies out of Nifty 50 stocks. Those were having maximum debt equity ratio as on 31st July 2017, 3 years back, and see the price performance, stock price performance over the period of last 3 years. So here these are the 10 stocks, and these are NTPC, Vedanta, Adani Ports, Tata Motors, Hindalco, Mahindra and Mahindra, Larsen Toubro, Tata Steel, Power Grid, and Tata Power. All are having more than one debt equity ratio. NTPC 1.16, Vedanta 1.18, Adani Ports 1.28, Tata Motors 1.35, Hindalco 1.39, Mahindra and Mahindra 1.64, L&T 1.88, Tata Steel 2.34, and Power Grid 2.39, and Tata Power massive 3.69. This is hugely burdened by debt. Let's have a look at the price performance now. NTPC has given minus 36% return, Vedanta minus 59%, Adani Port minus 20%, Tata Motors minus 76%, Hindalco minus 26%, Mahindra and Mahindra minus 14%, L&T minus 23%, Tata Steel minus 31%, Power Grid minus 20%, and Tata Power minus 41%. None of these companies has given positive return over last 3 years. If we could simply filter out these stocks, those are highly burdened by debt, we can avoid massive losses. See the what has been the performance overall on an average basis. These stocks have eroded our capital by 35%. So this 35% erosion we could have saved if we were not invested in these companies. So while using this debt equity ratio, the most important part, the most important criteria, or we can say the most important use of debt equity ratio, is to filter out the bad companies out of your portfolio, and the companies those are having healthy balance sheet. So there we need to we can have a filtration process to filter out great companies and to remove bad companies based on debt equity ratio and all other parameters. When we can put together, like we had already discussed, that is the ROCE, the best financial ratio, to find out great management and product and services. If these two things will be combined together, we can have a very great portfolio. But as far as this debt equity ratio is concerned, we can save ourselves from capital erosion, as if we had invested in these 10 companies, those were highly debt burden, our portfolio would have been from 10 lakh to 6 lakh 50,000 over a period of 3 years. Then we could have said that the more money we could have made in fixed deposit if we had kept that in bank. But see, before investing in stocks, it's our responsibility to either consult with the advisor or to do their own due diligence, at least to filter out the worst performance, worst balance sheets out of your portfolio. So this was for the day, and I hope you understand the importance of debt equity ratio. If you have any doubt or query, you can write down to me. I'm available on WhatsApp, LinkedIn, Twitter, Facebook, and you can comment on the description box here. Also, all my links are available in description box to contact to me. I will keep on coming in with new videos to polish our technical and investing skills to trade and invest. So do subscribe, do like, and Keep on learning, keep on watching. Have a great day. I'm Vivek Singhal from tradingwithvivek.com. Thank you.